Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Friday, January 8, 2016. So we had another down day today, obviously. It was more of a melt away in the afternoon session. And just to give you a glance so we can look at it together, on the 10-minute chart, you see the market was really kind of holding steady. Wasn't really down all that much. It was kind of flat for the most part until the middle of the afternoon, and it just kind of melted away. And that doesn't necessarily bode well for Monday. Remember, today was the turn day, plus or minus, so it's now the plus 1 day. We should begin a rally next week, even though it doesn't feel like it. I get that. I understand fully how it feels and what it looks like. And if you listen to the talking heads on TV, they're ultra bearish. And that's actually what you want to see, because the more bearish they get, the more likely we are closer to a turn. That's the way it works. A few months ago, Carl Icahn came out with a video that he released to the world, essentially, saying how bearish he was. And that video came out, I believe it was either here or here. One of the two. I don't remember exactly, but it was one of those 2 days. No doubt in my mind. And that marked the bottom. And I believe it was yesterday that George Soros came out and said something similar. I don't know exactly what he said, but it was to the effect of how bad things are and all that stuff. And I'm not denying how bad things are. I'm a trader. So what we're doing is we're just trying to identify turning points in the market, and we're happy to make money on either side of the market. I don't really care which way it goes. I just want to be, on the right side with the institutions. That's all that we're really trying to do. So, I'm not a bull, I'm not a bear right now. I mean, overall, I'm probably more bearish than anything else. But overall, I'm looking for a turning point. And as it looks now, based on today's close, I believe that we're going to see another leg down on Monday, but I still believe that we could see an intraday turn on Monday. Worst case is Tuesday, kind of an overnight thing, Monday night to Tuesday. But I think maybe we'll see an intraday turn on Monday. I wish I had a crystal ball. I can't really tell you exactly that that's going to happen or not, right? That's impossible. But I know we're close to a turn. That I can tell you, or at least we should be. If we're not, then something else is developing that doesn't hold water. But we should be close to a turn. So we have this green line in here down at 189.77. And I said last night that, it's possible that we could hit that today if we got a big down day. We didn't really get a big down day, but we did get a down day nonetheless. 1% down on the spider. On volume, 209 million shares. That's nothing to sneeze at against an average of 122 million. So if you look at it in terms of volume and in terms of the type of day it was, even though it kind of all happened in the last, for the most part, the last couple of hours. So basically, it was a decent down day, but not enough volume to signify any kind of a bottoming signal. If it was down very heavy into the green line on extreme volume, that would be different. But it wasn't. So I think there's probably some more downside coming on Monday. But just the same, we could see an intraday turn Monday afternoon and can reverse the whole thing. So here's the number, 189.77. And I put one more line in here, 188.27. That would be a secondary target. And the reason I put that line in is because it's a gap fill from down here, and I'll just point it out. So the market, if we begin to break down below 189.77, we may want to fill the gap at 188.27. If we break below that, then something else is developing, and we could head down for the lows from last August down here. I don't think that's the likely scenario, but I'm giving you the reality that could we do that? Of course we could. We could do anything. I'm telling you what the probabilities are based on my work, based on my calculations, based on my time frames as it stands today. Is something else developing? I don't think so. If we get a very bad close on Monday and we're below these levels down here, okay, then possibly something else is developing and we'll talk about it then. But I was a little cautious. I put out one trade alert today, this afternoon, late in the day. Kind of went a little bit in the hole after I put it out. I kind of suspected that might happen if the market sold off. But I wanted to get it out there. It was Gilead Sciences. And the reason I did was because it was showing relative strength as the market was selling off. And it was on my radar screen. It was one of the stocks I was looking at. It was at a level that I think is an institutional support level. And therefore, I was comfortable to put it out. I'm not worried about the 50 cents or 60 cents or whatever it was. It was down from where I bought it and took the trade alert. That's not, I didn't buy my stop is nowhere near here, and I didn't buy it for a 50-cent gain either. So it's not the issue. I'm looking for a rally in the market, and stocks that have relative strength when the market is going down will rally in excess of what the market rallies. And that's why you look for stocks like that. Just the same when there's stocks that are extremely weak and the market is strong, it's a sign of poor things to come for those stocks when the market does show signs of weakness. So this is the flip side of that. Works both ways. Real quick, let's look at the IWM. The IWM was down 1.5% today, and it was down, 0.5% more than the S&P or the SPY. And if we just get a snapshot of the weekly chart, look what happened here. So the weekly chart, all right, we broke through the head and shoulders pattern, and we closed below the weekly number on the 200 period moving average. That's bearish, okay? So I'm not suggesting that just means that we're going to have an all-out collapse in the IWM, okay? There's a pretty good chance that it's going to want to rally back up to this break point here. That's generally the way it works. And where that break point would be is in the neighborhood of about 107 to 108, and potentially get back above that neckline, okay? But that's where we are right now. That's where it stands. It's pretty weak stuff going on, okay? Here's the head and shoulders on. It's really from the monthly chart, which is more bearish than anything else. So here's the thing. Since it's on the monthly chart, pardon me, I shouldn't have brought up the weekly, but since it's on the monthly chart, it all depends on where the month closes on January. And where the month closes in January will be important for this neckline on IWM. So we have a lot of time left to determine that. And if we do get the rally that I'm looking for, could we get back inside that neckline? Yeah. Will we get back to at least test underneath side of that neckline? I firmly believe that that'll be the case. But it's important information nonetheless. IWM, very important index. Look how weak that is, even in relation to the spider. Okay, so if we look at where the August lows were, okay, which were down here at 108.25 roughly, all right? And then we broke below that in September as compared to the S&P, okay? The August lows were here. We made a higher low in September. Whoops, I didn't mean to do that. I'll have to readjust that later. I forgot what the number was. Bear with me. Okay, it's fixed. I couldn't wait. So the lows here in September, this was a higher low, while the IWM was making a lower low. That is a sign. It's like a shot across the bow. It's very similar to in 2008 when Bear Stearns had a couple of hedge funds. Actually, I believe it was 2007. Bear Stearns in March had a couple of hedge funds fail, and that was the shot across the bow of things to come that really got underway in October of 2007. So this is similar in relation to the major markets, and when you look at the IWM making a lower low while the S&P or the SPY was making a higher low at the same time frame, that's a shot across the bow. This is a leading indicator one way or the other. A, either on the downside, or B, on the upside. One way or the other, it's generally the leading indicator. Let's take a look at the transports today. Now, they were down less than the spider. They were down 0.7% today, or 49 points. But again, Look how weak the transports are. Here's the weekly chart. Remember I said a few days ago we were going to get to the 200-period moving average. That was a fait accompli. That happened. 65.60 is the next target. I don't want to see that on Monday because that will generally mean that we're getting more of a sell-off than I'm expecting in the spider. So I would rather have the transports wait a while to get to the 65.60. I don't necessarily want that to happen all in one day. That would mean an ugly, ugly day or two for the markets, uglier than we've seen thus far this week. This is the weekly chart, so keep that in mind. We shouldn't get there all in one day. Okay, so let's go over to the gold market. So the gold market basically was back and forth today, and right now is trading at 1104. The pit session closed today was 1097, but we're trading at 1104, and therefore it really still remains in a bullish position. This is nothing more than a pullback in a continuing uptrend that I expect to see more upside. We got a reaction off the initial $1,110 target that I expected. But I do expect higher prices. That was my initial target. I think we're going to get higher prices, and we'll see what happens next week. I wouldn't necessarily run out and buy it here. That's not the prudent thing to do. I'm just telling you what my thought process is and what I think the likely move is going forward. What's the line in the sand if you are long gold or GLD or any of the other vehicles? The line in the sand is a daily chart close below 1085. That's my line in the sand. The 50-period moving average is down here at 1082. So it really can be in that zone between 1082 and 1085. I've got 1085 based on my number, and the 50 period is 1082. So you got to give it a little bit of room there, but I don't want to see gold close anything significantly below that level, certainly on an hourly basis, and particularly on a daily chart closing basis. If that happens, then I think the upside may be over for the time being, but I don't think that's the case. I think there is higher prices coming in gold. Silver, though, had quite the pullback today, and you can see it gave up all the gains from yesterday. So that's a little ominous, and I'm not sure how to read that one way or the other. Is it an economic-related issue? Is it a metals-related issue? Is it a, dollar-related issue? I don't think so. I don't really know how to read the divergence that occurred now between silver and gold. Silver was down almost 3%, while gold, while it spiked a little bit lower today, it really isn't down all that much. So it's got me a little bit scratching my head. So I'm not going to say one way or the other what the expectation is. What I will tell you is that as far as I'm concerned, this was a bearish pattern, and this was a bearish pattern, a bearish wedge pattern developing. We had a one-day spike up to the 50-period moving average, but the fact that we couldn't close the day above the level right here, that was not bullish. It was not necessarily bearish because it could have closed above there today if we had another follow-through day, but we didn't. So it was more of a just not bullish sign and more of a neutral sign because it still could have had more upside potential, but it didn't happen. Had quite the sell-off. So I don't necessarily like that, and I don't like that divergence. So I think that is a sign of some caution if you're in the metals market. And I'll just leave it at that. And by the way, the GDX pulled back 2.5% today, but it was really just a pullback. You're above the moving averages, the 50 and the 20 period moving average, and you actually finished the day a lot higher than was the low. So I'm not looking at that as any kind of significant trouble whatsoever. But I don't like silver, so that I will tell you. Crude oil. Crude oil, same routine. It's just, further melting away. Did not put in any kind of a trend change reversal signal as far as I'm concerned. No reversal bar, no reversal candle, no engulfing candle, no doji candle, no nothing. So it's still showing signs of weakness. There's nothing you can do. Down another 39 cents, over 1%. Nothing you can do except wait. Patience is going to pay off in the crude oil market. That's all I can tell you. I didn't mean to bring up that chart. What I did mean to do is bring up the bond chart. And bonds had a little bit of a higher day, or a little bit of a tick higher, and were comfortably above the level of 155.25 at 156.12. So it was the right move not to take that bearish pattern, even though the setup was there. I would have been stopped out had I taken it. The setup was there. It was the right move in terms of a chart setup, but it was also the right move not to take the trade. I can't tell you exactly the reason why I was uncomfortable taking that trade, but I did tell you I wasn't going to take it, full disclosure. But that chart pattern, under normal conditions, probably 80+% of the time, I would take that trade. I don't know exactly what held me back. I just didn't feel it. And I don't know how to describe it that way other than I just didn't feel it. So we are trying to get back inside the channel. What this is telling you is, as money comes out of the stock market, it is going into the bond market. Higher prices are coming or have come in the bond market. But as you can see, this channel, the underside of this channel, has proved so far over the last couple of days formidable. And it did prove interesting when we did break down from it. And the chart is drawing in the channel, not me, right? I'm just going by what the chart is telling us. And the chart is telling us that this upward channel is providing, the bottom side is providing resistance on the upside. As the market moves higher, the downside or underside of the channel is providing resistance. I find this stuff really, really interesting and useful when looking at charts, patterns, pricing, and I just find it useful when making trades. And I guess in the back of my mind, it did play a part in the reason why I didn't take that trade. So I think these things are very important and always play a role in my decision making. All the information that I described to you and a whole lot more plays a role in my decision making abilities, or my decision making period. Not abilities, my decision making period. So that's it for the bond market. We'll just see if we get one more day or any number of days down further in the stock market. You could expect more upside momentum in the bond market. It's simply connected at the hip at this point in time. Let's go to the dollar, and the dollar had a little bit of a higher day today, but interestingly enough, what happened was we had a very, very quick spike, if you will. In fact, let me bring up the 10-minute chart, and you can see here we had a very quick spike and then a very quick sell-off. And what was this from? This was from the phony jobs number that came out this morning. And, when we talk about the Fed on the Fed days, you've probably heard me say a number of times, generally the first move is the wrong move. And markets whip around these important, what they think are important economic and related announcements. So I want to bring up another point, and I'm just going to flip over. So what happened was the market spiked up on the phony jobs number from the Labor Department at 8:30 this morning, and then the dollar sold off from that. And so I find that interesting. I don't know that that's really useful information. I just find it interesting that it happens over and over again. And where did we spike to? And it's not ironic, but I say ironically enough, we spiked right to just about yesterday's high. Okay, so this is the way markets work. Yesterday's high provides resistance. A former low provides support. It just happens like that over and over and over again, and nobody should be surprised when they see things like that. You can't necessarily know in advance that the high was going to provide support at that point in time, But as it provided support, but I can tell you what you could have known if you're watching, it's not necessarily the dollar, but a chart like this, okay? When you see a spike like this and it fails, and then you see an engulfing candle back down, and you see the market continue back down and take out the entire move, and then begin to put in a bearish pattern like this, down move, bearish pattern, you could suspect that the highest probability from that point forward was further lower prices. That's the way it works. What happened further from that? Another bearish pattern, lower prices. Okay, so while you may not be able to catch a move like this from here, okay, that's very difficult. What you want to do is be able to identify the chart pattern that puts forth the next likely move or the next likely scenario after a big move. That's the way you play those type of events. So let me go back to show you something else. This is the S&P futures. This is the E-mini. Okay, so here's a 10-minute chart. Where's 8:30 in the morning? Right here. So 8:30, the announcement comes out. The next candle opens, which is the 8:40 candle on my 10-minute chart, and the market spikes up, and it spikes all the way up to a level that was important to me. Okay, 1064, 1065. This is right at 1065. Okay, and the market got to a high of 1064.75, and then it failed. So the first move was the wrong move, and then the market started coming down and never looked back. And, you know, we had other levels that provided support in intraday, okay? And folks that get my S&P E-mini numbers in the morning know these levels because these are the same levels that you got, and you knew those levels from early this morning. So if you're an intraday S&P E-mini trader, it helps to have identified levels before the market really gets started for the day, so you give yourself somewhat of a roadmap for the day and understand what you're looking for. You know, for example, when a level like this, okay, this level here at 1037, okay, that's this level right here, 1037, okay? So the market comes down, okay, and it hammers on 1037 for 1, 2, 3, 4, 5, 6. So basically an hour, maybe a little over an hour. It hammers on this level for an hour to an hour and 10 minutes. Okay, this is a bearish pattern. So the probabilities were that as we come into this level like this, that it's going to give way. And then what's the target? Well, the target becomes the next level. Doesn't always work out to be as precise like this as the target gets hit within the next 30 minutes. But nevertheless, you know where the market is likely going to find the next major level of support. Not a level for 5 minutes, but the next major level of support. And look what happened. At 1926, the market had staged a pretty big rally. Okay, then it failed again. But this is the way, if you're going to trade, you know, the market intraday, the S&P E-mini, for example, or any other market, you really need to understand where your levels are before you get started for the day, because you need to identify where the support and resistance level are likely to be, and then watch what the market is doing as they come into those levels and see if you can, you know, confirm one way or the other what the likely scenario is based on a pattern, based on a reversal candle, based on a spike low, based on, you know, here we had a spike low, and then we had the next candle, we had a big reversal, and we had a pretty decent close. And as you start to see the rally ensue, you know that the next level of resistance was going to be back to the underside of the prior support level, which would become resistance. And for a short-term trader, that's exactly what happened. Even if it's for a couple of minutes, it's a trade. And then we busted through it and did the same thing at the next level. And that provided another good trade. Bearish pattern, and you know the way it works. So anyway, I thought I would just make mention of that, something a little bit different than I normally talk about. So we talked about the market, the SPDR, the IWM, the transports, gold and silver. We did the bond market, the dollar. Now we did the S&P E-mini. Interesting today. Let's talk about Apple for 1 second here. And we showed a little bit of relative strength in Apple on the daily chart. Now the market is getting hammered, and Apple seems to be finding some kind of footing, finished up for the day, scratched out a little bit of a gain, up 58 cents, but it's a gain nonetheless. So you want to look at these things as proxies. You know, I would have loved to buy Apple at 92 if it held today with both hands. We never got there, but the low today was 96.76, which really, you know, wasn't down all that much. And so I thought it was interesting. Nonetheless, we opened at 98.55, but then we traded down to a low of 96.76, but finished positive nonetheless. So I thought that was interesting. Everything else was pretty much taken out to the woodshed, you know, energy related. We've got Exxon down, Chevron down, junk bonds were down. We haven't looked at this in a while. Junk bond index is just making a bearish pattern on the daily chart. You know, this is nothing that you haven't seen before. Melting away, bearish pattern, below all the moving averages. You know, it's just nothing good here. There's no rally coming in junk bonds anytime soon, that I can tell you. What else is interesting? XLE melting away. So, you know, we caught the low here off of the double bottom, but then now we have more work to do to find the next low. So you go over to the weekly chart and it's too low there. So now we have to go to the monthly chart. And where's our low? 54.26 is the next pivot area that I would be interested at to find some kind of a support level or a some kind of an interim bottom, and that would coincide with the 200 period moving average, which is this little tiny black line, which should be going across the screen. I'm not sure why it's not, but this comes into the support level, which is a pivot low here, which is a lot of chart support in this area. You've seen me do this before. When the price of a equity or stock or index, in this case it's an ETF, you know, fights a level like this for a long period of time, it's telling you that this level, whether it's 58.74, 54.26, or in between, this level is important. And it did the same thing here, fought this level, came below it, fought back, broke out above it, came back to test it, pivot low. Okay, and this is a monthly chart, so these are long-term price support levels. So this is going to be support. It's not going to just crack through there and make like this stuff didn't happen, you know, over months and months and months. So you can expect a support level down at 54 to 54 and a quarter, you know, give or take. That's, you know, good information. You can use that to your advantage. So I think we'll use that as the ending point tonight. And I wish everybody a pleasant weekend coming up. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.